Hey, everybody. Thanks for joining us. We're here at the somewhat belated 11:30 panel on distressed investing. We have a fairly large crew of folks here who have lots of things to say about distressed investing. And you just heard us joking about it earlier. You know, this panel might not have been as interesting to folks a year ago or 2 years ago. But 10 or 12 years ago, you certainly wanted to know what we were talking about. And you probably do in the next couple of let's call it 6 to 12 months or 2 to 3 years, however, depending on how rosy or pessimistic you are about viewing things. So my name is Jeremy Johnson here from Polsinelli. We'll start with introductions. Let's start over with you, Bill.
Yeah, nice to meet you all. My name is Bill Bymel. I am the founder of First Lien Capital. We are investors in non-performing, sub-performing residential mortgages. I've launched in March of last year. We placed just over $30 million of equity in the space over 12 deals in our first year. I've got 14 years experience doing this since the last downturn. I was previously with Spurs Capital as the number 2 guy, kind of the bird leaving the nest last year. I was personally responsible for over $250 million of equity investments in this space. I've got 20 years experience in real estate as an investor. And like I said, 14 years in buying loans on the secondary market.
Ann?
Hi, everybody. I'm Ann Rutledge. I'm the founding principal of Creditspectrum Corp. We called R&R Consulting. We're a 22-year-old free market rating agency. That means that we are not registered with the SEC, but we are allowed to operate. We played a crucial role in the establishment of culpability and enabling investors to get damages through the GSE, because effectively I started our rating agency at the end of 1999 to address what I saw as a structural flaw in the structured finance market. And I would say that the opportunities for distressed have never been better than they are right now.
Hi, my name is Chris Lawrence. I am the founder and managing partner of Labyrinth Capital Partners, a firm that I started in January 2020. Before that, about 11 years running a global secondary practice where we raised and deployed about $1.7 billion over that time. So I've seen a cycle or two in markets like this. So I think I'm pretty confident in knowing what premium sort of buyers are now looking at in terms of providing liquidity. So we function primarily in North America and Western Europe, looking for investment opportunities. We do not do the limited partner interest secondary part of the equation. We are after more or less the entire private market spectrum, encompassing working with private equity managers and/or exactly with portfolio companies or family offices in businesses that they may hold, where they're looking for some sort of structured liquidity solution.
Hi, I'm Jay Freeman, founding managing partner of BlackView Capital Advisors. Our name actually originates from my distress and turnaround background, which is helping companies find their way back to the black. My career spans private equity, management consulting, in the turnaround and restructuring space. We focus on lower middle market companies, those with evaluations of roughly $50 to $350 million in total enterprise value. Our kind of investment strategy is what I like to call a vast investment strategy, which is value, kind of growth, minority piece with actual influence, active control, and then special situations in turnaround. Yeah, that's me.
Thank you. My name is Kevin White. I'm a founder and managing partner of Spring Hill Capital Advisors. We are a largely family office investment group. We have 3 very large families that most of our capital comes from. I spent my career at Lehman Brothers. I was in the triage room when the heart stopped beating. So we can talk ad nauseum about that, and all the books you read. I can give you a hands-on book review on which is accurate and which is not. Most are not. After Lehman Brothers went bankrupt, I started Spring Hill the next day. I didn't have a business plan the day before, but I figured that I too can bankrupt a company. So I figured I was start my own 150-year-old company. So I can start my own.
Started at the top
when
it came to bankruptcy.
And had the good fortune of meeting a handful of billionaires that were trying to help Lehman Brothers out with their portfolio and buy real estate. So after the bankruptcy, we set up a little merchant banking business and went off and bought a lot of distress during a crisis, a lot of securities distressed up and down the capital structure, and then loans And then as the business rhythms, unfolded, we sold our last investment on March 6th of 2020, not knowing there was a pandemic around the corner. When the pandemic hit, we figured for sure there'd be more distress coming this way. And boy, were we wrong. It went the other way. So now we're hoping that our instincts are right and we get to see some distress in the next downstroke.
All right. Well, thank you. So we obviously have a lot of experience and I think we got some good stories with this panel. From my perspective, my name is Jeremy Johnson. I'm a partner here in the New York office at Polsinelli. Been doing distress my entire career for 20-something years here in New York City. Represent primarily bankrupt companies or people who want to invest in them or purchase them out of bankruptcy. So nobody wants to invest in a bankrupt company, but you want to take it after it goes through the bankruptcy process. So that's the side that I work on primarily, and we're legally obligated to put in a Polsinelli plug whenever we talk about this. But one of the things we do here at Polsinelli is something called the distress indices. If you look up Polsinelli Distress Index or Distress Index, you'll see that there's a product we put out every quarter, and it tracks bankruptcy filings with only Chapter 11s with assets of over $1 million. So it tries to provide sort of a focus of what's happening in the bankruptcy world. It has two sub indices, one's for healthcare, one's for real estate, and then it tracks all Chapter 11 filings. But if you look at that, it's only one measure, of course. There's a lot of distress that never touches the bankruptcy world, and preferably it avoids the bankruptcy world if you can, because it's very expensive and very public. So you like to do it outside, but we track it all, and that sort of provides an indicator, I think, of what's happening, and it tracks the filings on a rolling 4-quarter basis. So we get sort of a broad view on it. But if you want to check it out, you can. It's just got a lot of pretty graphs that shows, what kind of companies are filing and why. So I appreciate everybody's time here today. And I guess let's start off with you, Bill, since you've had the longest break now after we got through the introductions. And let's talk about, we're all talking about sort of, we see things happening now, we see distress happening now, interest rates going up, debt's significant. What's your view of the current environment? So let's see if we can get the panelists' view on what angles they see as particular areas that may be ripe and provide opportunity for investing.
Sure. And feel free to jump in. I think that when you were saying, that we were all expecting a ton of distress as soon as COVID hit in 2020. And there was about 30, 60 days of good buying there. We did well in those, April, May of 2020. But I've been I feel like I'm the only one screaming from the rafters saying there's a bubble or there's problems here. Why are we printing money and keeping interest rates low? And this is not going to look good. So we are obviously in a state of transition in the market right now. Just in the last 90 days, I've seen, just anecdotally, I'll give you an example. Major mortgage from originator, one of the large 5 originators in the country, does a quarterly sale. They'll sell both performing loan packages and non-performing loan packages. Performing loan packages would traditionally new origination, 700 credit score borrowers, perfect packages. Those will trade normally at par, maybe even 101, maybe in the high 90s. The performing loan package from this mortgage company sold less than the non-performing last quarter. It sold in the 60s of value. And, these were 2% and 3% and 4% mortgages. And it was a clear beginning indicator as to where the market is heading, where the discontinuity is coming from. Any other comments? You guys?
I was just saying, there was a panel earlier was talking a little bit about venture capital investment and the implosion of the valuations, et cetera, et cetera. So one of the things I'd probably just put a lens on is that if you go back about 18 months, you had a lot of valuations that were here. Okay, then all of a sudden we had the first quarter of this year where the tech sector, for example, cracked. Well, I can tell you a lot of the same technology-oriented or VC-oriented companies that were looking to hire bankers who signed contracts with these bankers to go raise that next round at a valuation that was supposed to be north of what they did 18 months ago. I haven't seen this since 08, 09, where bankers are pulling those contracts because there was no way they were able to achieve that objective of getting them A, the capital, and B, the valuations that they want. So what's actually happening now? I've been inundated with what I'll call a bunch of, quote, insider rounds, right? These are where if you've got capital and you can protect your own investment, but take advantage of the situation because you are providing liquidity to an illiquid asset, game on, okay? And this isn't going to stop. Now, understanding risk, preservation of capital, which I'm very fond of, the businesses still have to be real.
Sure.
There's clear indications that a lot of these valuations and money being thrown at are still in that idea generation phase. So what we try to seek at Labyrinth are situations where we can take advantage of where we're getting paid for the liquidity we're providing, where the businesses themselves are actually cash flowing with good balance sheets. Okay. But for some reason, it feels like right now you're going to actually earn alpha without having to do too much. And I haven't seen that in probably the last 2.5, 3 years, but it's starting to come now.
Just started.
Yeah, I mean, and I'll say that I saw a little bit of that in sort of a discrete spot. We had a company that was coming out of bankruptcy in the distress. It was a nursing home company that was emerging from bankruptcy right when COVID hit. Probably the worst time you want to try and get. It was 110 nursing homes in Texas, and we sold off 80 of them and tried to emerge with about 25 or 30 at the end of the day. And what was interesting there is that was a private office saved the day. So we had MidCap Capital was our lender. They were exit financing lender. They were going to provide the exit financing for this 25 SNF operator on emergence and all down in Texas. And they backed out because of COVID. And we were all in front of a judge on March 3rd saying, you know, MidCap said they wanted to take a month. And we're like, it doesn't work like that when you're trying to get out of bankruptcy. You got to go. And it was interesting. The transcript doesn't read so great given what's happened the last couple of years because everybody's like, COVID, you're walking out because of COVID. And a family office investor was in the deal earlier as a potential lender to the distressed company. They stepped up and did the loan. MidCap agented the loan. But the family office put the money in, and they put in, you know, a decent chunk of change at extremely high rates and made a killing on it. And what happened in the nursing home industry during the beginning of COVID, the government just threw money at them, and they eventually paid the whole loan off after about 6 months out of the bankruptcy. So it was an opportunity where you know the family office is in the right spot, and these folks put money to work and got a pretty big payday. So in terms of comparing what's happening or what might come about in the next couple of years to what happened in the past, and do you have any thoughts on that? I mean, you're coming at it from a different angle from these folks, you know, from the rating agency perspective. You know, I know there was a lot of criticism about what happened back in 2006, 2007, 2008, and, you know, some blame was thrown about as to how we might have gotten to that process. What are you seeing that's different now compared to then?
Much deserved criticism, I would add.
Yeah.
Thank you for the photo op. You know, I think that I'm sitting between two very critical people whose perspective on the market is so important. As a rating agency, and my only capital at risk is my own. Credit matters, liquidity matters. And what we've seen since before 2006 was a running dialogue about what is this about? Is the market about liquidity? Is it about credit? I think that the longer term view is that static balance sheet analysis is giving way to cash flow analysis. We're seeing a blurring of the boundaries. Liquidity matters and credit matters. And what I am is I'm a clock. I'm a clock on credit. And I think that what is so significant about the moment right now is not so much the state that different enterprises, different borrowers are in. I think that there have been mispricings all along. I think value has taken a back seat, but rather it's our awareness of the factors that matter. We have to raise the level of complexity and awareness when we look at distress situations. And I think we'll find a lot.
Well said. You know, I don't think we're in the oh shit phase yet. We're
Technical term, right?
Yeah, that's look that one up. And that's when obviously when the blood is really in the streets and when Chris and I will be very excited. But I have my popcorn ready in the meantime. You know, it's the uh-oh moment right now. Do you agree with that, Tim?
Yeah, I think there's been a sea change. Like when the Fed posture changes as quickly as and dramatically as it has, and the markets back up, the rate markets back up. That's a kind of like a geotech plate shift, and it's going to happen, right? The tsunami is on its way, and it's going to hit, and we'll find out who's over levered, who's been irresponsible, and there's going to be a ton of workouts in the next few months. But it's coming. It's coming for sure.
I'll just chime in and say, I think one of the big things that's very different from the last time is where capital sits, right? You had a lot of the major banks that were in on the middle market space before they had to unwind those businesses. So you saw a lot of people kind of come out and start their own shop, right? We could all throw throw a tennis ball to like 10 other shops that are doing private capital lending. So now you have to look at what does this environment look like, whereas before capital had to be sent to these larger institutions to help save them. What's the government going to save XYZ capital that has this portfolio, right? So I think there's going to be more robust opportunities because there's not the shield that there was from the governmental entities to kind of step in the marketplace where they were the last time around. So I think that's a major shift in what we're going to see in this market.
So still, I would argue though, the key point here is that if you're going to enter in this market, be patient. You hope to be directionally correct. You're not going to market time it to the exact time in December of 08 or February of 09. You're not going to do that. You just want to be directionally correct, which means you've got to be patient. So you also have to have the capital available to be patient over a period of time, which is why I don't chase IRR. If we've done the fundamental work to understand that we have a business here, we're getting a good entry price because of the way the market dynamic shifts, great. Then we're starting ahead of the game. Now the asset needs to perform, right? So you've got to take all that qualitative and quantitative stuff and muck it together and hope the fact that over a period of time, you can actually generate the return for the risk that you're taking.
Yeah.
What a lot of people missed in the GFC was they were trying to be market timers and they plowed in either too early or they got in just a tad too late to where they didn't get the expected return that they were hoping for.
And who would have thought that you could have value investing being something that's important? I've always focused on buying good assets from distressed sellers. So I want my distress to be in the sellers, not in the assets itself.
Right.
Yes.
Go ahead, Marty.
Yeah, so I have a question from the audience, which was, special situations, distress topic. How do you advise growth companies on dealing with down rounds?
Yeah, so I got one right now. I'm actually going to be meeting with the CEO tomorrow in Houston. Company was doing fairly well 18 months ago, raised at a $200 million valuation, cleared about 8 to 10 million of revenue. Don't know how they came up with that valuation, would never hit it. Today, company's actually going to do close to 50 million. It's on its path to being break even probably in the next, call it 4 to 6 months. But yet, because of the market, they had a banker that pulled the contract to raise that next money. And so internally, the management team and the founders, along with the 2 lead investors, basically said, okay, we're just going to do an insider round. But in doing an insider round, it's also an opportunity to say, listen, if we're going to bring this new money to bear to meet the objectives that we want for the long term, then let's sacrifice the pain now, get a deal done so I can get the cash in to operate the business I want to. That's a hard conversation that is now occurring all over the place. Some people like it, some people don't. What ultimately happened means any early stage investors here that aren't participating in those new conversations, okay, are looking at substantial equity loss. Okay, so at the end of the day, you have sort of a rebalancing effort, okay, for the people that are sharing the risk in a market like today need to get paid. Okay, and if you're not going to come to the table with your wallet and we're going to carry the water for the rest of the way, the growth investor, in this case, the 2 lead guys at the board along with the CEO said, okay, let's just do it. Let's do a quick 15 million. Let's get it done in a month and let's move on because I don't need any more money after this. Those are the conversations that are very difficult for CEOs that have been like trying to hold on or early stage investors trying to hold on. That's the problem with this market. If you don't have the staying power to protect your interest going forward, this is what's going to happen to you. And the cram down rounds are going to start happening.
I have a question. What do you think the implications are for it? And this right, we haven't seen markdowns in portfolios. So you talk to CIOs and foundations, endowments, right? That had, and I'm just using that as an example because they have to pay out 5% a year, right? So their portfolio went from 600 million to $1 billion because their long equities were up huge. They're now required to pay out based on those valuations, but the private stuff was marked up and not marked back down.
Yeah.
So now they have a mark to market on the liquid stuff, right? They don't have a mark to market, and so they still have to pay the. Do you see that as? See, I see it as creating pressure.
It's immense pressure.
Because there's on the amount of capital to take advantage of these deals that we're talking about.
Right.
Absolutely.
So yeah. So if you look at a pension plan, just very easy. You always hear about the above the line and the below the line, right? For me, they normally have an allocation to private markets or private equity. Let's just use that as a general line. Say it's 14%. To your point, when the market's cracked, all of a sudden that 14% became 16 or 17% of the portfolio. Now the board mandate was 15%. Now what do they do? Right?
It's a denominator.
It's a denominator effect that then may force that CEO or pension board to basically say, I got to seek liquidity to get back into compliance, or they get a hall pass, whatever happens, right? This was a lot of what happened in GFC. To your point about private marks, okay, everybody understands that Topic 820, thanks Gap and everybody, tried to actually allow private equity or private markets portfolios to be valued within a framework, right? Tier 1, 2, or 3. Good luck. Because all it did was put up goalposts, and I appreciate that. But it still allows a manager to flex conservative or aggressive on those marks, which, oh, by the way, won't show up. That March little crack that we had for tech, all that VC stuff, that won't show up until you get your quarterly report in August.
If done.
Right, because you've already got a quarter lag, and then they're going to maybe changing some valuation techniques. So there's a little bit of gamesmanship that's always being played, which is why you got to know your manager, which is why you have to understand exactly, well, how are you valued, right? I mean, I'm in the middle of an audit on my last fund, and it went easy because we basically were looking at all the same metrics and being consistent on that approach. Other ones are not. So to your point, it's about knowing your manager, knowing your CIO, trying to figure out exactly what the liquidity spectrum looks like in that portfolio, to then navigate to figure out what's going to happen. Because Bill and I were talking earlier, the fourth quarter is going to be an interesting time, which always happens, right? Market downturns in the first half of 2022 are going to turn into sort of the repositioning of a portfolio at the end of the year, where everybody can basically say, okay, I'm just going to take the portfolio management distress now. I'll clean it up by year end because the market's down, and therefore I'll hide it under here. Okay. There's going to be 4 months of major selling happening between September through December because everybody's, by the time the marks come out, people are going to be rebalanced.
Yeah, no, that was interesting when you made that point, Chris, because I was thinking, you know, what's gonna be the spark? I think there's so many either zombie companies or dead men walking in commercial real estate or whatever it might be that have we've been able to kick the can down the road for so long. And I think that's a very good point, that now those managers, those investors, whoever is sitting on bad distressed assets can now use the excuse of the market as their reason to exit these what they knew were problems all along, but just have been kind of just letting it sit underneath.
I mean, there's other pressure. I mean, so my position is that we're like in 2008 again. In 2008, many of the companies never actually cleared, right? There's no market clearing on them because rates were down so much, right? So you've got that added pressure as well. You've got guys who were going to retire in 2008 and then they stuck with the business, and now they definitely want to retire. So you've got that added pressure, and then I don't even know where we are in the deleveraging cycle, right? I think we're in the first inning.
Yeah.
Any thoughts on that?
Definitely early innings.
I would say earlier, and Jay may want to speak to it from a turnaround perspective, but let's be very frank. What's eerily similar to GFC is that we have a bunch of credit, right? All over again.
Yeah.
The difference this time around, it's actually cheaper priced debt, right? That's been on the balance sheet. That is actually, in most cases for businesses that have cash flow, can actually service that debt, right? From a liquidity and credit perspective. So that won't necessarily be the big thing that hits right out of the gate, right? It's going to be the operating metrics that go into these businesses about whether or not they're actually hitting substantial headwinds or not.
Okay, another domino, right? I mean, the largest companies in the United States, many of them are global companies, and global markets will seize up, right? I mean, you've got many, let's say your Latin American company, all your debt is denominated in dollars, there's dollar shortage, so that's going to start locking up, right? So those marketplaces where you sell Pepsi or whatever, craft goods, maybe not, as liquid.
I think that
It's not a domino, right?
I think the fund, I don't know if we're in it's going to be that binary where all of a sudden we go into a complete wipeout scenario. I think what's happening is you're going to see this sea change from momentum investors and speculators. We've seen, with all this easy money, we've seen speculation, right? Crypto is one of them, right? So I'm at the hospital and my son's having an appendectomy, and 3 people are talking about, I'm day trading crypto, options, and gold. I'm like, seriously? Like, yeah. And so all this kind of newfangled stuff, right? Because people have been in the markets for a long time. Like, there's nothing new on Wall Street, right? These new products, they're just some form of, yeah. So it's going to happen. So that the small value group that's been, harassed by the momentum growth people for the last decade are now going to take control and reprice things, right? So the value people are going to step in, and there is a clearing mechanism and a price for this, but a lot of people are going to get wiped out, as they should. A lot of speculators should get wiped out.
And I would add to, I think another big change, and you guys can disagree, but in the paper that's been issued in the last decade, Colin, since the crisis, particularly in the smaller and middle market, is floating rate.
Yeah.
And it's all floating.
This is exactly,
Good
I was
point.
gonna say, the leverage loan and the CLOs were characterized by the NAIC as the survivors of the GFC. Well, maybe not this time. We actually have a rating on the leverage loan market that's based on rating implied spreads. And I can tell you that our ratings are wrong. But I don't know how to get to right ratings because they don't indicate the degree of leverage or the level of overhang. But once it starts to tank and you add to that the floating rate index and you.
Well, and add to that BDCs, absolutely, where there's some very good ones, but there's a lot of, I mean, I was used to be in that business, like, there's a lot of that underwriting in these firms that has been obfuscated by the rate environment.
Yeah, so I was actually gonna tap in and piggyback off that, and I'm sure Jeremy could speak to this. The underwriting in a lot of these things, what we're starting to see is our bankers are looking to get things off their balance. It's not even a big thing for them, but what they're saying is we know how the underwriting looks, right? There's a lot of gaps in how assets can be maneuvered around, and that's really what you get to see. I mean, we've seen it with a lot of the big cases of, subcos here and there getting assets and redistribution because the underwriting of these things, there's really nothing to hold it, right? We've been in this cov-lite, if there are covenant environments, what are the true breaks? And so I think that's another thing that's going to make this market really special. There's not a lot of teeth in the underwriting, as you mentioned, particularly in the middle markets, lower middle markets, where it's going to be a knockdown, drag out fight between creditors and other investors on where's the true value of the asset and where does it end up being in these layers of companies. And so, Jeremy, I think you can speak to that because that's what you do.
Yeah, I think
Well, either investigate it or create it, depending on what side you're on, but yes.
I think the one word of caution that we're seeing and we would like to share with you is when you ever hear the word the non-bank lender, right? So what's happened, with the regulation on the big banks, right? The regulators have forced the banks up the capital structure to higher FICO, to better quality loans, and so all these Wall Street guys, right? That left the street to set up these non-banks, right? They're all in it for themselves for the most part, right? They're taking massive risk. And so here's an example. There's another subprime crisis brewing right now. In the Fannie, Freddie, Ginnie, right? Ginnie, very few people follow Ginnie. Ginnie's gone from 700 billion to 2.1 trillion in the last 7 years. And so what FICO's in there? Everything below 700. So, and who are those borrowers? Well, they're the old subprime borrowers, right? A lot of them are Army or working, so they're legitimate credits, but they're taking on a lot. So what happens when that goes? And who are the lenders, right? Ginnie Mae typically keeps the loans or stays on the bank's balance sheet. There's one bank out there, Wells Fargo. The other 19 of the top 20 are non-bank finance companies that aren't capitalized, that don't have the reserves, that it's going to end badly, and it's coming.
Can we just talk about that cycle? Because a lot of people went bankrupt in 2008, 2009, and came out of bankruptcy in 2018, 2019, only to go back into the same loan products they were using pre-2008. I mean, so we're underwriting lots of these things, and they have 11, 12, 15% non-performing loans. And so what's the takeout, right?
But all of this depends on the resolve of the Fed, all of it. So the question is, what do you think is the coverage of the Fed, both in terms of interest rates policy, as well as selling off their debt, to recapture bucks and.
But the Fed's dual mandate, they're trying to get inflation down to 2%. The market's already priced in a bunch of other hikes, and the Fed's going to continue doing that, and they're supporting that. So that's where it's going in that direction. So if you think you're in trouble now with where your rate is, you're going to be in a lot more trouble in 6 months, 9 months, and a year.
Anybody with variable rates will suffer.
Or even it's just the refinancing. If you can't refinance and your equity's gone, right? You buy something at a 4 cap, now it's at a 5 cap. Right, you just lost 25% of your valuation.
My generation, I'm 46 years old, so I remember when my father came home in 1981 and was like jumping for joy about his 11% FHA mortgage, So my generation's never been part of this upward movement in rates and the inflationary situation.
What we did was 60%.
Right, exactly.
7 days.
Yeah.
I remember.
Yeah, and so it'll be a very interesting wake up to
46, you're just a puppy.
I know. I was gonna say I was the youngest guy in the room, but I looked at that guy, he's like in his 20s.
we got about 15 or 20
Go ahead.
minutes.
Bill, you touched on before, you said commercial real estate. I know Jeremy, you said Texas. With commercial and multifamily, and I know you're not a soothsayer, have you seen any kind of these geographic Sun Belt West start to crack a little bit?
Well, I got a couple of stories for you. One is I just left a family office small group with a bunch of that were guys that were really just commercial real estate guys. And what the general consensus was, deals that they were like the number 3 or 4 bidder on in January, and they were 10, 15 points back in terms of their pricing, they are now being brought back those opportunities now. So a lot of this stuff, there's a lot of deals that are falling apart left and right in commercial. I will also tell you that I was in November, I was in Dallas, one of my law firms hosted a thing with bankers and whatnot. And I was sitting with one of the senior executives at one of the major 5 banks, and he's in the SAG department. His mandate, he heads commercial non-performing debt. And his comment to me then in November, before any of this came about, was there is a ton of dead men walking in commercial. To speak to what Marty was saying, or I think maybe you said it, was that, since the GFC, it's been downward rates pushes. So it's allowed a lot of these commercial guys to hide the dirty laundry. So we're starting to see that crack now. Yeah.
And we're seeing that in terms of the bankruptcy filings. And because I will say that, when the pandemic hit and the office spaces were emptied, right? And every publication in New York talks about how, the office is at 30% of what it was, 40% of what it was. We're like, well, geez, let's get ready for the real estate filings. Let's deal with all these big commercial real estate filings. And they haven't happened yet. For the reasons you were talking about, Bill. They've pushed them off, but we think, there's some cracks in the dam happening over the last 3 to 6 months on that. We're going to start to see it, which is, potentially going to be an opportunity. I mean, I don't know what your view of the world is.
I'm excited.
If it's all coming back, there's a heck of an opportunity. If it's to overuse the new normal, then maybe it's not the opportunity we want.
And that's the key for guys like us that operate in the secondary markets or our larger investors. There's real opportunity that happens when markets get discounted. This is where there's overcorrection that's going to take place, like you said, Chris, in the 4th quarter of this year, I think.
So just to be specific, what are you seeing in terms of data on the bankruptcy side? Because that is a real data.
Mm-hmm. Yeah.
Because all that
right. Anecdotal. Yeah.
Just from your perspective, what have you seen different in the last 3 months versus last quarter of last year? What experience?
Well, we're getting a lot more activity in the last 3 months than there was last year. I mean, and like you mentioned earlier, I think it was Bill that mentioned it earlier. So the pandemic hits, right? And I do a lot of healthcare restructuring. So it's always been, there's a ton of distress in healthcare. Even during the good times, I've been really busy. But all of a sudden, we started getting phone calls when the pandemic hit. Everybody was having problems. Everybody was having issues. What are we going to do about this? Nobody knew what to do. You couldn't forecast a solution, right? Because the pandemic had just started and you didn't know what it was going to look like on the other end. So you talk to your financial guys, what put together a financial projection for us. And they just, hands up, we have no idea what it's going to look like. And then vaccines and people started putting it together. But the bottom line is bankruptcies plummeted during the pandemic. I mean, there was a big punch right at the beginning with all the big hospitality shops, right? All the movie chains, the food and beverage, the retail restaurants, all those sort of folks, they all sort of got shut down. So they've all filed bankruptcy to take advantage of it. But since they've opened up, that part sort of eased up and bankruptcies really went away. In the healthcare space, they went away almost entirely, the lowest we've seen in 10 years. And we've been tracking the data since 2010. In terms of our internal data, lowest we've seen in years. It's starting to come back. We see more Chapter 11 filings in healthcare. We're starting to see more in real estate. On the general side, it's starting to pick up. Now, I don't know where the numbers are going to shake out. We'll know. We've got a whole process, and there's a data scrubber and a statistician, and I'm just the monkey at the end that puts everything into the PowerPoints that we do. Yeah, I mean, look, it's a bad sign when the real estate side starts to slow down and the restructuring side starts to pick up. We've seen this happen before. It's been 10 or 12 years, but it's what's happening right now. So
on the topic of data, though, I mean, there's no data on the leveraged loan market unless you're deep in that market. But we are also looking at public consumer structured debt, and there's a ton of data on it. And I can tell you that we've been watching the deterioration for about 4 years. I can also tell you that depending on whose data you use, it may be very different from the Edgar data. We use the government data. And some of the commercial providers out there are actually recharacterizing defaults as prepayments and getting away with it. So, but that's a very good source if you want to get some indication of what the global trend is.
Some of the point I'm trying to make is that the situation has changed in the last 5-6 months.
Yeah.
And I'm really trying to figure out like what are we seeing in the data. So I'm kind of a little bit more specific versus last year. That was the point I was trying to figure out, like what are we really seeing in the past given.
Well, as far as in real estate, canary in the coal mine is new home sales. If you saw the most recent report, down huge number year over year. That's one thing.
Yeah, I was just gonna say, if you got access and say you're in a fund of funds and you start having quarterly reports from all your different private equity and VC managers, take a quick snapshot and see how many of the new funds are actually investing in the old funds portfolio companies. You never see it, but those are basically demonstrable saves that sometimes the LPACs don't see.
Right.
Okay, and that game is being, I can tell you, hands down. Everybody came rushing back this first quarter. I think I'll give you an example of how much capital was trying to get raised quickly. Okay, where managers barely had any DPI, any distributions, zero distributions in some cases. Went to a pension plan that said $1.3 billion that they're ready to allocate for all of 2022. Talked to him at the 4th week. He says, Chris, you're on the docket for this year, but guess what? We're already done. Okay, these guys have already floated up and put all their money back with their managers, and they're out of the market for investing new. And I said, that's great. How are you going to protect your positions? Right? Because at the end of the day, if you got no more dry powder, you're going to miss out on an opportunity. To me, that's an aggressive stance where people are just trying to get it out. Right? Get it in the hands of people they thought. But I can tell you, this cross-funding stuff is where, again, talking about people, fiduciary responsibilities, I hate to say it, it smells a little bit like what I saw in the GFC all over.
And that stuff only gets exposed after a little bit of time.
Right. Well, that stuff takes even longer.
Right. I think Bernie made a.
They're still exposing what happened.
Yeah.
You know,
Right.
that's still, that dirty laundry is still being aired right now. So go ahead.
Well, I guess quickly from our vantage point, operating a number of energy-related yield products for the last 40, 50 years. You know, one thing we've seen, especially from people who've been with us for a long time, and some of the older generation at their shops, is that, you know, the structural amount of retirees that they're now they're dependent upon their investment strategies. It's like 5,000 a week, 10,000 a week, different from each shop to talk to. They're chomping at the bit to structurally sell growth or fixed income. And you have some of these people who like to participate opportunistically, participate in ESG, they can't, right? They need a fixed income. So I'm curious, like, where does that selling pressure make you guys the marginal buyer risk? That's got to be the opportunity.
I can buy for 2 reasons. I can buy because the CIO and the endowment basically needs to repurpose the portfolio, and they've got a couple of co-investments. I don't buy LP interest, but I can buy off of distress too. Okay, so some of these private equity firms that are kind of trying to figure out how they save the continuation fund, okay, that may be self-serving for them to hopefully earn a carry check later, which isn't necessarily in the best interest of their LPs. You're going to see a lot of that infighting coming on. So when those arguments happen, they need a catalyst, right? The catalyst that actually is the pacifier is capital. We're that guy, okay? So long as we understand who we're getting in bed with, at the same time, what the security that we're going to get. So the distress can come from either above the line, below the line issues at particular portfolios. It can come from a CEO that basically says, you know what, I need to take some chips off the table right now. Or it can come opportunistically in a positive way, which is, hey, I actually have a counter-cyclical business model that should actually kill it over the next couple of years. And I want to raise some additional capital to take advantage of this, either M&A or just internal growth. So it can vary for me. I don't know about these guys.
Oh, no, I have no real comments, additional comments to that.
Yeah, we don't do anything energy, so.
So now I kind of want to talk about structuring, right? And I know we're in the early innings of this period, but there are some investments that become, very distressed, but are strategic. And the example I want to give is the mortgage marketplace, where people who were like mortgage brokers back in the day, everything was written down. the market's locked up, and and so we had a guy who's a billionaire out of California, and he was approached by one of our guys who had a mortgage bank. And if anybody knew anything about the mortgage banking, this is 2009, 2010, he was told that if he could get, the government would give him a warehouse line of up to like $100 million if he could provide $10 to $15 million of equity, right? And so the family office that approach was the guy who, was looked at every tranche. He's like, he said, look, I will give you a loan for this amount at XYZ interest rate as long as I get equity-like return. So I want like a 40% return on investment to give this line to get the government warehouse line, right? Which is a great deal for a family office. I mean, the returns were probably close to 40% on that, right? It was a loan structure. I mean, what kind of, do you look for structuring like that? What do you see happening? I mean, it's a great idea for a company that's going to grow, because who cares? You're going to grow. You're going to get a warehouse line at 2% rates, right?
Obviously, if I could get a warehouse line at 2% rate, I'll take it.
I'm not right. And the other guy's putting up some kind of pseudo equity, right?
Right.
I mean, so are those deals that you look for, or deals that you look at, or structuring that you pursue?
I mean, I just buy whole loans. That's all I do. Buy whole loan, mostly first lien. I'll buy the second if I own the first.
We look at a lot of deals like that. And so our capital, a lot of the families that we deal with, they're basically hard money lenders, but they're kind of
Sure,
fragmented,
yeah,
right?
exactly.
So the hard money lending business, whether it's a real estate or other things, or someone's desperate, but so then you're collateralized. So that's the stuff that we do.
Right. It's debt that acts like equity. It's collateralized.
Yeah, but you're not an operator. So a lot of times we'll look at something, we're not an operator, but someone else might be a hotel operator. We don't run hotels, but we'll give them some bridge financing or some rescue financing. I think that's going to be very, very common in this next cycle.
That's where you want to go, right? Because that's a timing issue.
Right.
If you're there with capital
Sure is.
and they need capital quick, you're going to get paid. You're going to end up with a debt instrument that has every shape of a senior debt type of security, but you're going to get paid in equity return. And that's a function of timing.
Yeah, that's a good deal.
It's a damn good deal.
I was gonna say, particularly in a middle market, lower middle market PE space, right? You have that flex point where, hey, listen, we're gonna give you some type of convertible where we're protected, particularly if you're in asset heavy industries, right? Where there's machinery, other things that you can kind of back your capital against, but saying, hey, listen, there's contracts out there, right? There's gonna be receivables that are coming. You're just caught at this inflection point. So we feel comfortable mitigating our risk based off of these things, but also saying, hey, listen, our downside is, well, machinery, the other things are there on top of the receivables that are outstanding. So you have that space to say, okay, we're going to take this kind of like hybrid instrument that has debt structure, but equity upside.
I would just add that the Rio to rental deals were effectively that, because what happened, except that the gain was buried in the price tag. So you had houses that might have sold for 60% that were capitalized as if they were worth, 1.5 times what they were worth. And that was okay by the rating agencies. So you got AAA like returns, but you built in a capital gain that you hadn't realized.
People forget that something that rescued the American real estate market was the fact that foreigners could come in and invest and buy single family homes for enormous amounts without any scrutiny of where the dollars came from. Right? That was
Look around Manhattan.
they're all
everywhere.
Florida. So a great example was that all the building in Brickell Avenue in Miami locked up, and from 2008 to 2018, I believe all new building was provided by what do they call these funds? Provide like some Chinese investors and
Right. That's right. There was no construction financing for about 10 years.
Right. So all the money that came in was EB5. It's your Florida, right?
Yeah.
And I'm going to tell you that the owner occupancy of Brickell Avenue new buildings is about 3%.
Yeah.
Well, and I will say, just as a PSA here, when you're talking about the notes you were talking about earlier, that these debt instruments with equity-like returns, don't skimp on your lawyers. Doesn't have to be Polsinelli. It should be. It should be. It doesn't have to be Polsinelli, but whoever you're paying, make sure you've got a good lawyer who sets it up properly, because if it's not set up properly, if you don't have every I dotted and every T crossed, that gives your owner, your operator, whoever, the opportunity to get you into a bankruptcy and take your debt and turn it into equity.
I'm
And
just
so,
asking, what's the worldview a family office should have in looking at deals? I mean, I said there's secondaries, there's distress. Again, I think somebody said, you're looking for distressed owners, not distressed assets. or
Right, distressed sellers,
businesses,
yeah.
Right? I mean, right, distressed sellers.
Look for
exactly.
quality. It's a flight to quality and it's cash flow and fundamentals, all the stuff that a lot of people have forgotten in the
Yeah,
last.
you'd like to be in a cherry picking mode.
Right.
My other question, somebody had asked about, had mentioned secondaries, and things did lock up in 2008 because there really weren't enough secondary funds. Now there's a ton of secondary funds, right? So does that mean
Depending on what you're talking
things
about
won't be
there.
locked up, but then there'll still be a race to the bottom because people can sell that?
No, because Marty, real quickly, the market last year was 130 billion. Okay. So of that, there were these quote GP leds and then the basic limited partnership interest stuff. This definition of secondary is if it's one expected return, okay, or one type of strategy is now completely misunderstood because everybody defines that term differently.
Right.
Okay.
True.
So if we're going to talk about LP secondaries, it's a very mature, it's a lever beta strategy now. To your point, there's nothing wrong with it because it's a function of private markets. So, I mean, it's going to basically double, even triple probably over the next 4 to 5 years anyway, because of the amount of private market assets in LP interests that are out there. But it's a very institutional approach. You can go to a banker and they will sell you a $300,000 piece in Apollo 8, or you can go somewhere else in the Bank of Japan where Evercore is doing a break for $2 billion. That market's never going to change. It's got credit type return with a different lower return profile. The GP leds, the continuation funds, the single asset stuff that you've been reading about, $30-40 billion market next year, not going to slow. Okay, again, it's all about a function of liquidity. But again, the return's not the same and the diversity is not the same. So completely different type of liquidity solution with a different type of return profile than what you're going to get over here on the other side.
And just to clarify, when I'm doing GP led, am I buying a part of a fund or am I buying?
No, you're going to be buying
individual
a
pieces of
concentrated
fund?
piece, either one asset or maybe a couple of assets. But everybody calls it GP led. The problem is when you're getting into $1 billion GP led transaction for a single asset, you're probably going to have 20 buyers there. You're not really going to get a great buy-in. And by the way, it seems like most of the bankers and the GPs start off winning on that because your entry price is never going to be at a decent price.
Kind of sidestep from that. I think the other thing that we have to look at in this market is over the last couple of years, a lot of family offices have started to do direct investing on their own, right? In individual portfolio companies. So that's one of the places that we kind of step in and look at those things because now they're tied up to these owner operators or they have an operating team that they have to now find a way to function in this environment. So if we're looking at that, particularly the lower middle market, it's, I think Jeremy mentioned, right? How do you get, now you're in this distressed environment, how do you get cash flow statements? How are you looking at the operating income? And one of the things we at BlackView, I've started to transition from a consulting perspective. We were working with a firm called New Point Advisors. Now they specialize in companies that do from $1 to $50 million in revenue, particularly around capital advisement and in the distress space. So I think and they're trying to build out, they're one of many players, but right now the only player that is focused on building out a national footprint for companies of that size. Most of the restructuring advisors focus on the large bankruptcies, the things that you'll see in the Wall Street Journal, but the fact of the matter is a lot of family offices aren't in those deals. And if they are, they're in, like you said, on $1 billion fund perspective. But now what do you do if you're the family office that, you're in on this company that's in on manufacturing or what have you? How do you operate in that space? Who's your advisor? Who are you going to? Who's helping, coach the company that you've now invested in? Who's got a founder who's never seen, a distressed environment or is a little bit older? Maybe they've made their money and they might be a little bit more comfortable walking away. So, I'll just say, find that person. I would love a call. And I think my good friends over at New Point Advisors would love it as well. Because that is a space where the family offices, they're going to need to find their way through. And you can't bring in an Alvarez and Marcel or Alex Partners to come into those companies.
One of the experiences I've had in the last year is a surprising number of family offices or private equity firms that got into asset-based lending but never really even thought that any of those loans would ever go bad. And now that they've gone bad, they're like, so it's obviously created opportunities for us to step in and buy that. If I was a family office, I would look for, those kind of deals, asset-based loans that you can buy at a discount because the market liquidity is dried up such that you can get it, take advantage of those.
And Bill, you said something very important at the beginning, which is, when you buy distressed, don't buy the asset that's not distressed. And I would just point out that one of the big mistakes people made through the GFC was a failure to understand that the metrics for analyzing asset performance are not the same as the metrics for analyzing company performance.
Right. So there's a lot of opportunity, is there not, in terms of investing at massive discounts into portfolios of PE managers and VC managers, no?
Depends. Depends on the market in which you're interacting. I can tell you that every family office or every CEO, if you're doing stuff that I've seen stuff for a $20 million LP position, the NAV was $20 million last year, but there was a major crisis going on with the institution that held that, and they were willing to sell it at 50 cents. Okay, but they needed it done in 2 weeks. Okay, I don't buy that stuff, but I did see it and I referred them to somebody that could. Those are very hard to find today because almost everything is intermediated in that LP interest type of market for the discounts that you're achieving. But there are going to be always situations where distress is, where the distressed seller is, who needs a flight to capital.
Yeah.
The problem is, how do you find that? That's very rare.
That is true. I've had to do that for like the last 5 years without any distress out there, right? And so like, for instance, my focus in year one of First Lien Capital was going to larger private equity firms that are wrapping up the tails of portfolios they bought 6-7 years ago and taking those tails off their books. And that's the kind of crumbs that I've pieced together to spend $30 million in my first year. I expect as Chris said, I expect the fourth quarter to be like an order taking opportunity. That will be a lot more.
I think that's not right.
We have an audience question from online. So from Camille Holmesy. Some people know Camille. All right. So raising interest rate incrementally is not as effective at curbing inflation versus making a full assessment of the state of the economy and what caused the inflation to blow up and start with higher interest to slow the economy. So asking if we should just do one big shock, high interest, or incremental.
Don't ask my opinion on that. I don't know.
I like a longer runway to invest because
I feel like it's so much money out the door in 30 days.
I kind of want a little bit more predictability, but of course I like to invest over a 24-month cycle rather than investing over a 2-month cycle. So I think a shock may cause a little bit of concern for me, and the ability to actually see what's actually going to happen with some of this stuff. That's my standpoint.
I can't imagine what that would do to our economy, like a huge, couple hundred basis point jump. And the reality is, Camille makes a good point. It's like, these little incremental pushes every month or every quarter may not be enough to stave off inflation that, if you look at it by the 70s metric, is actually worse today than it was back then.
I'm just gonna say, I think Powell's been doing a really good job at signaling, even when things change, right? It was, hey, we're gonna do a quarter point, half a basis point, now we're 3/4, what have you. There's a level of responsibility that he has to kind of give the market somewhat of a heads up. I think we've seen in the past what happens when you kind of go with that shock and awe, and it's tough to come back from it, right? And so it's like, you can do that, but then are you prepared to clean up the mess that causes? And I don't think we're in that position, right? We're sitting in a if you looked at 08, the trick was, hey, let's lower interest rates, right? We can get things stimulated again. Well, we're in this environment where there's pain at the end of this, but all the usual tools that we utilize to kind of alleviate that pain are no longer accessible to us. So then what does the shock and awe thing do to an environment like this when you then can't use the tools that you usually use to kind of alleviate the pain that you usually
I
get?
love your comparison,
It's
but
about
I
5
was,
minutes left.
but-
Or 79 in
Well, but-
2008.
but the reason that rates
Yeah.
were lowered was because the Fed bailed out the banks. If they hadn't done
Agreed.
that, they would have been underwater themselves.
Yeah, but this is very different. This has got nothing to do with the rates. This is a supply chain shock, right? And so rates don't have any impact. Higher rates will just negatively affect the supply chain, right? So it's a total supply. So the world's economy.
There's a risk of shock with overshoot.
Well, think of the world's economy as this very complex watch, right? And over time, it's become perfected, and there's all these little cogs and wheels and springs and moving around, and all of a sudden, someone starts to stick right in there. COVID, right? That thing got busted and now it's all trying to repopulate and refix. It's just gonna take time. Rates have nothing to do with it.
Or
Well,
they have
but
only a
there's a
small
restructuring
piece
is
of what.
applied
they
to
do.
But
Capital.
I mean, I'm saying hiking rates is not gonna make it go away.
But inflation will continue.
Inflation will continue until the supply
Until the
chain
supply
gets
chain
care. You
works
can't
itself
fix that with.
$20,000 tank.
You have to recognize that there's a
Was it
decoupling
The
going
rates
on
on
in the world, right?
the tankers, what they were paying, was it up from $4,000 to $20,000 per
But
unit?
aren't there
Right,
also
right.
factors
Supply
that are beginning to moderate the momentum and monetary momentum and inflation? Anyway, starting to rectify, some people are saying. For example, I'm invested with a group called Cumberland Associates, David Kotok, who's quite a long.
Sure.
And he pointed out that a lot of the dislocation in the labor markets, which have been driving up wages, etc., has been post-pandemic problems. Either with long COVID, which has immobilized a hell of a lot of the working force, or post-vaccination problems, which are not really being recorded that well by the CDC. And that's contracting, so that the employment numbers are dislocated and misinterpreted. So that there may be already a kind of a consumer-based retraction going on that could moderate. And if you do a shock, you may well overshoot those interim trends.
Right,
And
good point. Yeah, very well. Which is the American way, overshoot, right?
So.
Can't get anywhere without
Can you
you.
guys give a quick rundown? We've got about 3 minutes left. So give your favorite sectors for right now and your sector you're looking out for 12 to 18 months.
Well, I can answer quickly because I'm only in one sector, which is, residential real estate. I have focused on the major cities, believe it or not. I'm a believer in New York, for instance, because we haven't seen the exponential rate pricing increases in New York like we've seen in Phoenix, Arizona, or Austin, Texas, these green and growing areas. So I'm value oriented. I think buying first lien mortgages at a discount to their face value offers a huge amount of downside protection should real estate values turn around as they might, and as they should. Markets are cyclical and it's time for a cycle.
I'll just, okay. My main point is that the private ABS market had a potentially $63 trillion size that doesn't exist. The market doesn't exist because the metrics don't exist. Right? The approaches don't exist. They could. We see them. We advise in them. And so the opportunity that I see is the relative value comparison. If I'm going to buy something that's distressed, that's known, why don't I look at something that I didn't understand, but that might give me more value?
So we're after money multiple here, but we're doing it without risk. So I don't invest in VC risk. I'm not here to fund capital losses or finance to some idea that they're going to get break even in the next 3 years. So I don't do that. I like to sleep at night, which means I don't do commodities. So I don't want to ride that wave. So what we're trying to do is just basically find in the major GDP categories. We're in healthcare. We're obviously in software tech. We're in consumer a little bit, watching that one closely, obviously, in manufacturing and industrial. So we're just looking for good, healthy businesses where we think there's a pain point for a solution to where we actually can write it out, being patient and generate money multiple in just a less risky way.
And that's what you're looking at right now. How about in 18 months? Anything that you anticipate?
Oh, I think you'll probably make a little bit more of a move to see exactly where consumer is going to go. There's a couple businesses that we're looking at now. I just need to understand some models that are going on and see whether or not they've actually got the right customer that I think can actually handle what's coming.
Yeah, I think the place to put money is to your point, manufacturing and industrials, also piggybacking off where you're saying the second part is right, because then someone still has to get out there and be a part of the supply chain and distribution to the consumer space. I like to say, companies that make the goes intos, like this thing goes into that, goes into this, right? They're kind of usually stable. Again, they have the assets, physical assets to kind of help you securitize against some of the downside. And you see a lot of those companies in, Chicago and Cleveland, et cetera. They're boring, but they have cash flow. And again, they have the assets to kind of, to protect you. The other thing is coming out of the other end of this, they're also heavily investing because of the labor market, right? So you're seeing a lot of investment in saying, hey, listen, we can't get enough people to come in here and work. So now there's a modernization and technology investment. So going back to software, right? These companies need to have software that can be smart to kind of go through the factories and pick and do automatic, we've got AI and things of that nature. So I think that's kind of what we're looking at. And we think there's a ton of runway today and then going forward to your point, the 18 months, it takes you all the way out there.
Yeah, I mean, there's a real change, I think, in supply chain win, so to speak, in that there's this decoupling going on. And so investing in manufacturing and industrial, you want to make sure that if Taiwan's invaded, you've got great chip manufacturing in the US. Right?
Yeah, we're focusing on multifamily right now. And the reasons are over the last 10 years, a multifamily developer was building in these tertiary, secondary and tertiary cities, Austin, Boston, in Nashville, and they were building at really, really high price points. And there wasn't really a demand for that. And we were financing it perfectly. So meaning that buying something at a 3.5 cap rate and financing with 3% debt or 4% cap rate and 3% debt, that whole metric is kind of, it's reverse course now. So now the debt's coming due, cap rates are rates are 5% or higher, and now those asset values are going to change dramatically.
Are there mortgages of these things generally fixed or variable?
They're usually like a 3 or a 5 year, like a fixed, and then a floating after that. But they're not going to take that interest rate risk, and they're going to try to refinance it out. And so there's going to be bridge capital that needs to come in, or you buy the asset to be able to get the